October, November, and December all had sales higher than the prior year. Average age, the median age of a first-time buyer was 35. We have demographically driven demand. It's a little weaker right now because of affordability issues. Important for you to know that investors still make up a huge percentage of the residential market. That's important to note is because of all the different types of debt out there, mortgage debt is probably the safest.
All right, I'll give it just a second for everyone to connect to audio and we will get started with today's presentation. Very excited for today. It's always one of our most popular things. People always want to know what's going on in the market and get some insights on the housing forecast. So we have our spring housing forecast with Rick Sharga today. So thank you all for joining. Let's go ahead and advance today's agenda. We're going to go over some economic overviews, the housing market overview, some stuff on investor activity, distressed property market, and our 2025 spring market forecast. And then, of course, we'll give lots of time for Q&A. If you could do me a favor, the optimal way or the best way to ask questions is through the Q&A function down at the bottom of your screen. So if you can please put your questions there, we will try to hold off for most of the Q&A to the end so we can make sure we get through our presentation day. A lot of information to go through. So we'll go through those questions at the end in case unless something just happens to pop up that we need to address on site. But otherwise, drop your questions down there if you don't mind. We are recording, and this webinar will come out to everybody in the next, day, 2 days, something as we kind of compile it and get it out to everybody. And then if you could please, if you could take off your video and mute your phone so that we can make sure we focus on our presenter this afternoon. Quick commercial about us, A&D Mortgage. So this is our 20th year in operation. So we're excited to be celebrating 20 years of servicing clients across the United States. We were recently certified by Scotsman's Guide as the #1 non-QM lender in the nation. Very excited and honored to be part of that. You can see all of our stats down here. We're working with over 6,000 clients, offer 20 plus mortgage programs, operating we're so close to getting all 50 states, a couple more areas left to get there. 4.7, very excited about our 4.7 Google, Zillow, and Trustpilot rating, and all the great things that you come to expect with all the lenders that you work with, great turnaround times, and we have a fantastic loyalty program. You'll see our list of awards over on the right-hand side. We are very proud of the work that we've done in the lending space, particularly when it comes to technology and marketing. So we're very excited about being rewarded through all these different companies that have sent us these acknowledgments. Here is our national lending map. You'll notice some new ones on our list. We just recently got licensed in several states and the territory of the U.S. Virgin Islands. So we're filling in the map slowly but surely. We got a couple more left to go, but we're getting across the United States so we can offer our fantastic servicing and lending products across the entire U.S. All right, and without further ado, the man you actually came to hear speak, not me, Mr. Rick Sharga. So excited to introduce Rick. He is the founder and CEO of CJ Patrick Companies, a market intelligence firm for companies in the real estate and mortgage industry. So very excited to have you here. The acknowledgement, subject matter expert. I'm looking at this whole list of channels that you have been featured on: CNBC, CBS, NBC, CNN, ABC, Fox, Bloomberg, NPR. You're all over the cable channels. So very cool to have you on the call. Founding member of the 5-Star National Mortgage Servicing Association, board of directors of the National Association of Default Professionals, and not once, twice named Inman News Inman 100, an annual list of the most influential real estate leaders. Over 25 years of experience in the real estate mortgage industry, including roles as the EVP and market intelligence at Adam Data, EVP of Carrington Mortgage Holdings, which I worked at in the past, EV of Marketing, Realtech, Chief Marketing Officer of 10X and Auction.com. Woo! Very experienced. Appreciate you joining the call today, Rick. Thank you for joining, and we're excited to hear all you have to say about the market.
Thanks, Mike. Just sounds like I can't hold a job, is what it sounds like. But we'll
It's
see.
impressive and a lot to read through, but that's good because you got a good background and that expertise is what we're looking for.
Well, I'm glad to be here. Thank you for the invitation. Those of you who have Been to one of my sessions before, you know that generally we go through things in pretty rapid fire order. As Mike mentioned, copies of the presentation will be made available, and this is being recorded, so there's really no need to take copious notes. And we are going to go through a lot in a fairly short period of time. So we're going to look at the economy, the housing market, disregard the California market. I took that out in the interest of time, but we can touch on it a little bit if you're interested. We're going to look at investor activity, distressed properties, what's going on for the rest of the year, and some closing thoughts. So jumping right into the economy fooled a lot of people last year, including a lot of economists who were expecting a recession. It continued to grow throughout 2024, and it's expected to continue to grow as we move through 2025, although at a slower pace. And that's normal. The economy does go through cycles like this. One of the big drivers in the economy and an important consideration for everybody in the mortgage industry and certainly in the housing market is that about 70% of the GDP, the US economy, is made up of consumer spending. So if you look at the little chart on the right, those dark blue bars that are going up and to the right represent consumer spending. And that consumer spending really is what's kept the economy going and growing since we came out of the COVID-19 pandemic back in 2020. You can see we had a pretty significant drop in growth during the pandemic, but came soaring out of it as people rushed to spend those government stimulus checks. And that's one of the main reasons, by the way, we had the inflation that we had, but we're kind of working our way through all that. I'm going to put an asterisk on this slide, and we'll talk about this in a little bit more detail. There's a lot of uncertainty, a lot of volatility in the market right now because of the changeover in the administration, the new Congress, and a lot of the policy proposals that have been talked about. And there's a lot of uncertainty as to what kind of impact that might have on the short term and the long term of the economy. But right now, if you just look at fundamentals, the economy looks like it's poised for continued growth. I mentioned that a big driver of the economy is consumer spending. We are at a record level of consumer spending, even though we've seen consumer confidence start to actually drop pretty significantly over the last couple of quarters. And consumer confidence and consumer spending historically have kind of gone hand in hand. So the more confident consumers are, the more willing they are to spend, the more willing they are to take on debt, and the more willing they are to make large financial commitments, like, for example, taking out a mortgage to buy a house. And it's interesting that consumer spending has continued even while we started to see that confidence weaken a bit. And the first time it dropped was really during the pandemic. The next time it dropped was when inflation peaked and when the war in Ukraine started. And it's been kind of fighting its way back ever since. But we are watching this because there are starting to be some signs. For example, retail spending was down a little bit more last month than anticipated. So there are some signs that the consumer finance boom might be slowing down a bit, but at the moment, it's still driving the economy. We're also seeing some signs that the jobs market may be slowing down just a little bit. This, again, is nothing to get worried about at the moment, but it's one of those things that you keep an eye on as you're going forward. Unemployment rates went back up to about 4.1%, the most recent jobs report. Not at all a troubling number. In fact, anything below 5% is considered a very strong economy and more or less represents full employment. The number of jobs available, that squiggly gray line running across the chart, has been coming down fairly steadily since we got out of the government shutdown during the pandemic. During the pandemic, we had unemployment rates peak at about 15, 16%. We lost about 22 million jobs virtually overnight. And in the ensuing 2 years, we reclaimed all of those jobs and have been adding ever since. At the peak of the difference between job openings and people looking for work, there were about 2 jobs available for every person who was looking for a job. Now we're down to about 1 1/3 job openings available for people that are looking for work. And those jobs remain open, largely because there's some disconnects between geography, where people are looking for work, and where the jobs are available, and the skill sets don't always match. But again, we're still seeing job creation. We still have a lot of job openings. Unemployment rates are still low. So all good signs from an economic standpoint. I should point out that the most recent jobs report was too soon to factor in any loss of federal government jobs. I don't know about you, but I was personally surprised to learn that the federal government directly employed over 3 million people. That makes it inside the top 20 industry sizes of anybody in the country. Um, but the administration has announced they'd like to reduce headcount by about 10%. And it'll be interesting to see if that happens and what the impact is on the overall jobs numbers. Because there are more jobs available than there are people looking for work, and because of the nature of the jobs that are open, these are not all fast food jobs. We're seeing wage growth continue. And for the first time in a number of years, we're seeing wage growth consistently outpace inflation. So the most recent inflation number came back down below 3%. It was at about 2.8, 2.9%. And wage growth continues at around 4 to 5% year over year. So it's a really good sign that wages continue to outpace inflation. This will ultimately help on the housing market front from an affordability standpoint. We'll talk about that in a little bit. But it really is a positive in the overall economy that we continue to see wages outpace inflation. And today, wage growth is actually outpacing the rate of home price appreciation. So again, strong wages as we look at the economy. I mentioned that the consumers are spending like there's no tomorrow. Consumer debt they've taken on is now at an all-time high, over $18 trillion in consumer debt. Now, before everybody runs out and starts buying gold bars like William Devane tells you to do on CNBC, it's important to note that about 70% of that consumer debt is mortgage debt. So you guys are personally responsible for 70% of all consumer debt. Congratulations. Um, the reason that's important to note is because of all the different types of debt out there, mortgage debt is probably the safest. We're talking about people who generally have excellent credit scores, a good track record of making payments on time. We know that mortgage delinquency rates are near their historically low levels right now. And this mortgage debt is offset by $35 trillion of homeowner equity. So even though there's a lot of mortgage debt, there's even more homeowner equity to offset that debt. And that makes it relatively safe. That said, we are still looking at all-time highs in terms of credit card debt, in terms of auto loan debt, and we're almost at an all-time high in terms of student loan debt. And so those are things that we watch, and we watch that in particular because interest rates, particularly interest rates on credit cards, are the highest I've ever seen them. The average interest rate on a newly issued credit card today is somewhere between 25 and 29%. If you're lucky like my household and you have a couple department store credit cards, and you probably got a notice from the creditor that those interest rates are now somewhere between 35 and 39%. So if you're like me and you break out that Macy's card around Christmas time for your once a year shopping spree, make sure you pay that off soon, or you're going to be paying a 40% debt on top of what you bought. And that, these are rates that are high enough that they used to get you arrested for usury, or they used to be the kind of rates you get from somebody who would collect with a baseball bat if you were late. But now it's the new normal. We do know that the administration, that Congress, and that the CFPB are all looking at ways to try and cap credit card rates so this doesn't happen again. But right now it's a reality. And we're seeing delinquency rates on all these balances go up. I'm looking at this mostly as a reversion, excuse me, to the mean. Um, Even though delinquency rates have been going up fairly steadily quarter over quarter since the latter part of 2022, we're still not back to the same level of delinquencies we were at prior to COVID. So this is a normal or below normal rate of delinquency, but we are continuing to watch it just because it's going up. And again, going up at a time when there's so much debt and there's such a high level of interest rates. And if you're looking at now versus pre-COVID, credit card and auto loan delinquency rates are both higher now than they were prior to the pandemic. Student loans are a little misleading because up until a couple of months ago, nobody was required to make those student loan payments because of the CARES Act and things coming out of COVID. Now they're due again, so it'll be interesting to see what happens with their delinquency rates. And mortgage delinquency rates have been going up a little bit, but they're still less than 4% of the mortgages out there. So it's at again, a lower than pre-pandemic level and a lower than normal historic level in terms of mortgage delinquencies. In fact, if you look at the Mortgage Bankers Association's fourth quarter end of year report, you can see that delinquency rates were at 3.98% for mortgages. The historic average is about 5.25%, so way below average delinquency rates. And they tend to run very closely with unemployment rates. So at the time that that report was issued, unemployment rates were at about 4.1%. Mortgage delinquencies were about 3.98%. So if you want a predictor about mortgage delinquency rates, just follow the unemployment numbers and you'll be able to make a pretty good guess. I'm calling this the X factor when it comes to the overall economy because nobody's really sure what impact DOGE is going to have and what some of the policies that the administration is proposing are going to have. We're talking about tariffs on imports. Tariffs are not a new thing. We've been imposing tariffs on imports for quite some time. In fact, up until the early 1900s, I think it was 1908 or 1911 or sometime in there was no such thing as an income tax. All the federal government was funded on was primarily tariffs on imported goods. That's how the country started out. And just a little trivia note for you, because I'm sure you'll love to talk about this at your next cocktail party. When income tax was first implemented, it was imposed as a temporary measure by Congress and at 1% of your income. So this is why I no longer trust anything that Congress puts out that's supposed to be temporary, because income tax at 1% was supposed to be temporary as well. But the tariffs, historically, if you have high tariffs on imported goods, they have the net effect of making prices higher, which causes inflation. Now, there's positive reasons for tariffs because you're trying to bring more jobs back onshore and make sure that we have critical manufacturing capacity when we need it. And you're also raising money with the tariffs to put toward what the federal government needs to operate. But they do tend to be inflationary. They do also tend, at least in the short term, to cause job losses. So keep that in mind as we're kind of going back and forth on tariffs. Jury's still out, by the way, on whether these tariffs are actually going to be implemented or whether they're a really strong negotiating tactic being deployed by the administration to get foreign countries more in line with what we're trying to do. We've also talked about the deportation of a large number of undocumented immigrants. That could have an impact on our industry significantly because over a third of residential construction laborers are immigrant labor. And some percentage of those, some undetermined percentage of those laborers are undocumented. So we could suddenly be looking at labor shortages in the house construction market. We could also be looking at labor costs going up. So combination of higher costs of imported goods, higher labor costs could cause new home prices to go up later in the year. Now, there's already a 9-month supply of new homes available for sale. So whatever impact we have from tariffs or deportations probably won't hit until later in the year, but something to keep in mind. On the other hand, we are talking about a pretty significant reduction in government expenditures, which on the whole would be very good for the economy and good for the taxpayer. And we're talking about removing a lot of regulatory constraints that, again, could be good for our industry and could be good more broadly for business across the country. That could cause more economic growth. So nobody is really sure what the net effect of all of this is going to be. I'm sure if you watch enough YouTube, there are people there with subscription services who will tell you they know exactly what's going to happen. And for $5,000, they'll tell you how to prepare for it. I'm not going to go there. But again, there's a lot of factors at play that could change whatever financial projections you're seeing from economists make in today's market. The housing market, well, pending sales, I look at two forward-looking reports to kind of gauge what might be happening next. One of them is the pending sales report from the National Association of Realtors. And for the second consecutive month, that index declined. And what this index represents is where a buyer has entered into a contract to purchase a property, but the purchase hasn't been finally executed and recorded. So it's a really good predictor of what's likely to be coming in the next 30, 60, 90 days. And prior to December, we'd had 4 consecutive months where this pending sales index improved. Now, even when it improved, it was still around 80, and the index really shows a healthy housing market when it's at about 100 or more. So we're still looking at a housing market index that's showing a weaker than normal performance rate. And again, in this last report from NAR, we saw that the numbers were down in all 4 sections of the country as NAR breaks them apart. And the South is probably performing the best, but had probably the biggest drop in that month. And a lot of that we can probably attribute to unusually bad weather in the region during that period of time. But this is not a good predictor of us having a really good month. And the preliminary numbers I'm seeing for February, and the February numbers will be released later this week, suggest to me that we're probably going to see numbers come down from January, but perhaps be up on a year-over-year basis. And that's important, and I'll tell you why as we get into it. The other forward-looking indicator I look at is the Mortgage Bankers Association Purchase Loan Application Index, because people wouldn't be applying for a loan to purchase a house if they weren't thinking about buying one. As interest rates on mortgages rose from September, which ironically is when the Federal Reserve started cutting the Fed funds rate. So in September, we bottomed out at about a 6% 30-year fixed rate mortgage. And that rate rose up above 7% by the end of the year. And as it did, unsurprisingly, purchase loan applications declined as well. So those two metrics, purchase loan applications and the pending sales index, lead me to believe that we're kind of going through what will be a winter lull. And hopefully it will recover as we enter into the spring. One of the reasons I'm hopeful about that is that mortgage rates had declined a little bit, both from their recent highs and on a year-over-year basis. A year ago, we were at about 7.1% interest rates. Now we're at about 6.7, 6.8. So it doesn't seem like much, but psychologically, getting below that 7 is important for buyers. And it does seem likely that because of some of the volatility I talked about in the economy, we've seen the stock markets take a hit in the last couple of weeks. When that happened, we saw a flight to safety by investors. They bought more and more bonds. As they buy a lot of bonds, the yield on bonds goes down. And that yield on bonds is actually what drives mortgage rates. So, that kind of volatility in the market has actually benefited us in delivering slightly lower 30-year rates. And hopefully we end the year with these rates down in the mid sixes, which again, psychologically and actually materially does start to make a difference for buyers. That's the good news. So wages are up, mortgage rates are down slightly. Rising insurance premiums are becoming a growing concern and a much bigger part of the cost. If you look at this analysis, I think it was by a company called Insurify. Over the last 3 years, we've seen insurance rates go up by 52% nationally. And if you're in a market like Florida and Texas and Colorado, not unusual at all to see those rates double or triple on a year-over-year basis. California's had a huge number of people who've been canceled by the insurance carriers. You read about the Pacific Palisades fire or saw it on TV a couple of weeks ago. Big fires out in the LA area. That area had the largest cancellation rate by insurance companies over the past year of any part of the state. So the majority of homeowners there, if they still had insurance, and some people who had the property paid off didn't have insurance, but the majority of people in that region were insured by the state's FAIR Plan, which is kind of your insurance of last resort if you can't get a carrier to cover you. And another great example of a government naming something exactly the opposite of what it really is. But we're anecdotally talking to homeowners in the Gulf Coast region of Florida, Texas, and Louisiana, who are now paying more on a monthly basis for insurance than they're paying for their mortgage. So this is a meaningful issue. I believe it's one of the reasons we're seeing home prices hit a little bit in Florida and Texas. and again, in that Gulf Coast region, whatever you want to call the Gulf Coast these days. And we're probably seeing some homeowners unable to continue making their monthly payments, listing their properties for sale. But now that incoming buyer is going to have to factor in those insurance costs to their mortgage and their purchase price. So important for you all in the mortgage side of the business to be thinking about what these insurance costs are going to do to your borrower's ability to repay. And that's also true if you're doing, long-term loans for rental properties, DSCR type loans, because you're going to have to factor these insurance costs and property tax costs into the equation going forward. And property tax costs are another one of those things that is giving sticker shock to a lot of the people that bought homes over the last few years. When we've seen home prices go up 40 or 50% nationally since 2020, since the pandemic, property taxes follow right along with those price increases. So we've seen prices go up, taxes go up, insurance costs go up. Really a difficult model for both prospective home buyers, but also increasingly for existing homeowners who thought they'd locked into a 30-year fixed rate for their housing costs and are now seeing these increases in unexpected areas. The good news from an affordability standpoint is that even though prices are continuing to go up, they're going up at a slower pace. So the chart on the left is from the FHFA. That really constitutes all of the loans that are backed by Fannie Mae and Freddie Mac. Um, and those are 70% of the loans that are out there, 30-year fixed rate conventional loans. And those homes, the values, the sales prices are going up about 4.7% year over year as of January. If you look a year ago, they were going up by 6.9%. So again, still going up, but going up at a slower pace. If you look at the Case-Shiller numbers, the chart on the right, they went up slightly even slower at about 3.8, 3.9% year over year rate. Most of the economists I talk to, or the housing market analysts that I talk to, there's a consensus that this year prices nationally will probably go up 2.5%. If that's correct, it's going to be the first time in a while where effective home prices will not be going up at all, because that 2.5% increase basically is the rate of inflation. So it basically you're looking at flat home prices this year if those forecasts are correct. And affordability, we talked about wages, we talked about mortgage rates, we were talking about slowing home price appreciation. Affordability is improving slightly, but it's still near a 40-year low. This is a chart from the Atlanta Federal Reserve. I just saw a more recent report out from January, almost exactly the same as this number. But basically what they're saying is if you're a homeowner and you're spending 30% of your monthly income on housing, which is what they determine as their affordability level, you would need $120,000 annual income in your household to be able to buy a median priced home. The actual median household income is just below $80,000. So there's a $40,000 gap. This is the least affordable market that we've been in about 40 years. It's slightly better than it was 6 or 7 months ago, but still on the outskirts of affordability. So when it feels like affordability is a real challenge, it's because it's a real challenge. One of the reasons for that is the lack of inventory we've had. We're going to talk about that in more detail, but the reason I bring it up now is because the properties available for sale today tend to be more expensive properties. That's why the median price is so high. Very little inventory at the entry level. And those entry level homes are very, very often occupied by people who would have already tried to move up and therefore make those entry level homes available, but they can't afford the move right now either. So we're in a situation where I don't believe we're going to be looking at home prices crashing anytime soon. We've seen similar scenarios before economically. And what usually happens is you have a 2, 3, maybe even 4-year period where the market's just really sluggish. You have relatively slow home sales. You have very little in the way of home price appreciation. And gradually the market resets at this kind of new normal. And I think that's where we are right now. We're also seeing more sellers cutting their prices to close deals. Very unusual for price cuts to be as high as they are at this point in the year. I don't know if you realize this, but on average, about 33% of properties listed do have a price cut before they're sold over the course of a year. But this is not the time of year when we usually see that rate increasing. It's usually starting to decline. So whether this is buyers having more leverage in some markets, whether it's sellers being more anxious to negotiate to get out of a transaction, or to get a transaction completed, or some combination thereof, it is interesting to see that this is happening as we move into the spring. One of the reasons for this is there is more inventory to buy. We're up about 29% year over year. Still not back to where we were prior to the pandemic, but at the rate of growth that we've been seeing since the inventory bottomed out in 2022, if we continue at this kind of smoothed out pace, we should be back to pre-pandemic levels of inventory by the end of this year. So we are starting to see more available for sale. The more properties available for sale, the less likely it is that we're in a strong seller's market, where the seller is less likely to negotiate a price. So this is all good from a buyer's and affordability perspective. We're back to pre-pandemic levels of inventory in 7 states, but only in 7 states right now. And you can see those, they're kind of the light green areas. In fact, I take it back. I have 7, but a couple of these reverted since this chart was updated. But you can see again in some of these markets, we're nowhere near where we were prior to the pandemic. Pennsylvania's off by 50%, as is Virginia. Illinois is down 63%. Maine, Vermont, 61%. So a lot of these states, very little inventory. And one of the reasons that monitoring that is important is because it has a direct impact on pricing. Whether you look at long-term numbers between 2019 and 2024, or more recent price changes, which occurred here between December 23 and December 24, the blue areas are where you have less inventory, and where there's less inventory, you're getting higher price increases. So a lot of the Northeast, parts of the Midwest, some parts of California, but other parts of California, just the opposite, where there's higher inventory than there was. And we're seeing those prices decline a little bit. You can see that areas in Texas and Florida, we're seeing either slow price increases or price declines. Now, again, part of that's probably due to insurance and taxes. Part of that's probably due to a little bit of oversupply. So it's important to keep an eye on this. If you're lending to people who are buying out of state, it's really important to be paying attention to those local state numbers, rather than to just rely on those national numbers. And if you're in one of these markets where you're making the loans, you can be very, very useful to an investor who's coming in from out of state, or even a buyer coming in from a different part of the state, helping them understand what's going on from an inventory and pricing standpoint. One of the apparent contradictions in this, and it's really not, but we're not seeing as much new listing activity as we're seeing new inventory levels. Inventory activity is up about 4% year over year. And you remember I said that inventory is up 29%. So part of that's the new inventory. Part of that's the new listings. But the other part is that once inventory hits the market, it's simply taking longer to sell. And so it stays in inventory longer, which keeps those numbers up a bit. But we are starting to see new listing activity. That's important because a reason for the lack of inventory had been what economists refer to as rate lock, which is somebody sitting on a 3% mortgage, really couldn't afford to sell their house and buy a more expensive one with a 7% mortgage. So again, it's just going to take time for all of this to work its way through the system. But the fact that we are seeing an increased amount of new listing activity, I think is a good sign for 2025. So slightly better affordability in terms of mortgage rates, wages, and home price appreciation, more inventory available for sale. I believe those are all positive factors and should lead to a better year in 2025 than we had in 2024. This is the end of 2024 sales. We closed the year with a bit of a flurry. It wasn't just snow this time. We saw that October, November, and December all had sales higher than the prior year. That October sale number broke a 37-month streak where we had sold fewer properties than we had sold the year before. So over 3 years in a row, every month we were selling fewer properties than we sold the prior year. And that streak broke in October, continued through November, continued through December. And we saw those sales actually go up month over month as well, which is kind of unusual for the end of the year. So that was a good thing, and it gave me a little bit of hope that we were generating some momentum as we got into 25. And January numbers, candidly, were a bit of a mixed bag. We were up again year over year, which is good. We were down month over month, which has been the model for the last few years. So I'm not worried too much about that. Be really interested to see what February looks like. And again, I'm hopeful that we're up on a year over year basis. We will see later this week. But my belief is that we will surpass last year's numbers. In 2024, we sold about 4.06 million existing homes, a little under 4.1 million. That was down from the year before, and in fact was the smallest number of existing homes that we've sold since 1995. So even fewer than the number we sold during the Great Recession. So I am hopeful. I do believe we bottomed out last year. And because of the factors that I mentioned earlier, assuming another year of economic growth, I think we do start to come back, not in a roaring manner this year, but we do a little bit better this year than we did last year. New home sales were actually stronger year over year. We closed the year with about 684,000 new homes sold. Um, there were a lot of reasons for this, which we'll get into, but this surpassed most economist expectations. I'd been a little bit more bullish on the new homes market last year. I thought we'd wind up somewhere between 675 and 700. We wound up at 684, so I was close. Again, you see, most months we were better on a year over year basis. January, the numbers dipped a little bit, still better year over year, but they did dip a little bit from December. But prices also went up in January. So prices went up about 5% month over month, which is significant. But we did start to see a year where, if this was an annualized basis, we'd be at about 657,000 units. I still believe we're going to come in this year with over 700,000 new homes sold. One of the reasons is that builders are building. New numbers came out this morning. In fact, I saw them right before we went online. And so while in January we saw 1.37 million housing starts, the numbers came out for February. We were up to 1.5 million housing starts in the month of January or February. And the important thing in that number is that the growth is reflecting mostly single family building. Multifamily starts are very low right now because we had a record number of apartments come online over the last 2 years, about 1 million new apartment units. So builders are not building a lot of apartment complexes right now, but they are breaking ground on a lot of single family homes, which is what we need to make up the deficit in housing. New home inventory, and I said there were a number of reasons why we were seeing more new homes sold than usual. One of them is this: there's about an 8 to 9 month supply of new homes available for sale. Uh, that's much higher than the 2.5 to 3 month supply we have of existing homes for sale, but it's not unusually high for new homes. If you combine the green and red areas on this chart, those are the homes that are available for sale. The red area is completed homes that are available, and the blue area is homes that are under construction and available for sale. So while existing homes have been hard to find for buyers, new homes have been readily available over the last year. And this is particularly true in the markets where people have been moving to. So the builders have been very, very savvy about determining where to build new inventory. And they've been following population trends. So where they're seeing population growth and job growth, that's where they're building. So a lot of building has been going on in the Midwest, in the Southeast, in other parts of the South. Very little going on in the Northeast or the West Coast. Um, the other factors that go into new home sales are that the builders have been offering concessions. They've been offering concessions that are often equal to about 5% of the purchase price of the home, whether that's a price concession or it's upgrades. It's still a meaningful number. They've adjusted what they're building to reflect the higher cost of financing. So the price of new homes has actually come down since the peak back in 2022, whereas existing home prices have continued to go up. So the gap between the price of a median priced new home and the median price of an existing home is about as narrow as I've ever seen. And there's some months where they're almost equal. So if you can buy a new home for the same price you buy an existing home, I think most of us would probably opt for that new home. And finally, the builders have all been very aggressive about buying down mortgage rates. I recently spoke to a group of mortgage executives in Denver where I saw a billboard where a builder was advertising mortgage rates at 4.9%. So they're coming into closing with cash and buying points to pay down these mortgage rates, either for a few years or for the life of the loan. And again, really lots of good reasons for people to be looking at these new homes. One thing that new homes and existing homes have in common is almost none of the inventory is at the entry level. So again, these are all somewhat more expensive properties. The reason the builders are catching up now and need to catch up is they really have been underbuilding since the Great Recession. So there was about a 13-month supply of homes available for sale in '05, '06, and '07, right before the market crashed. And then we had that glut of supply that needed to be sold while we had millions of homes going into foreclosure. A lot of them were relatively new homes too, so the builders were competing against their own recent inventory. It was a mess. And so they just stopped building until that inventory worked its way through. And then gradually improving, but they didn't get back to their long-term average of about 1.5 million properties completed until 2023. And they did it again in 2024, but you can see just looking at that gap, you can imagine that there are properties that are basically being bulldozed every year, that are being obsoleted every year, and they weren't being replaced. At the same time, the population was increasing from 300 million to 340 million people, and people needed a place to live. So there is a shortage. They are starting to make up for it. They're not going to overbuild because they got burned doing that right before the Great Recession, but they are coming back in larger numbers. And the reason this is important, even more important, is that we have demographically driven demand. And if anybody's wondering about demand for housing, it's a little weaker right now because of affordability issues, but demographics suggest we still have a lot of pent up demand. The average age, the median age of a first-time buyer, as of the date of this report, late last year, was 35. Now, I've seen some recent data suggesting the median age is now up to 38, but let's use this for today's purposes. That tells us two things. One, it tells us that compared to about 10 years ago, the median age of a first-time buyer is almost 10 years older. So it's taking these first-time buyers longer to get into the market. And again, that's largely due to affordability. But this is a millennial group, and they've basically been doing all of these events in their life later. They're getting out of school later. They're getting their first real job later. They're getting married later. They're having kids later. And those are all kind of catalytic events that lead to home ownership. But that group, which now comprises the largest cohort of home buyers, has not yet peaked at home buying age. And in fact, we won't hit that peak until next year. So I know we've been talking about millennials coming to market for what seems like the last century or two, but the reality is they have not yet peaked in terms of home buying age. And even when they start coming off peak, you have another 4 or 5 years of really well above normal levels of home buying age adults coming to market. And right on the tail end of that, we get the older cohort of Gen Z coming to market again at numbers that are higher than we've seen really since the baby boomers. So we have a number of years of coming demand, and we have several years of backed up demand, pent up demand, people who are renting because they couldn't afford to buy. So again, another reason I'm optimistic about the housing market, both in the near term and long term, is just population. It's what's happening from a demographic standpoint. And by the way, research suggests that these groups want to be homeowners at least the same rate as prior generations have. For those of you who do business purpose loans, working with investors who do fix and flip and buy properties for rental purposes, important for you to know that investors still make up a huge percentage of the residential market. About 25% of all residential sales last year were made by investors. And I believe this is actually understating the number. I'm doing some research with a data company right now to try and validate that. But this data from CoreLogic only accounts for purchases that are made by an entity with a commercial name. So LTD, LP, Corp, some sort of corporate name in their uh, uh, some sort of corporate name. So the individual investors who haven't incorporated, who haven't formed LLCs, they don't count in here. And we know there's a lot of those sort of accidental investors on the market. But even with that, and even with investor activity being down slightly, it's not down nearly as much as traditional home buying activity is down. So again, we're looking at over 25% of all residential purchases being made by investors. And here's the important part, and something that I think we all need to communicate to everybody that we meet. The overwhelming majority of these investor purchases are not by large investors, not by institutional investors. They are by mom and pops. So these are purchases made by small investors who own between 5 and 10 properties for the most part, maybe even less. Um, the next biggest group is mid-sized investors who own less than 100 properties. And then you start to get into the bigger investors. But collectively, if you look at single family rental properties that are owned by investors across the country, all of the institutions combined own less than 4% of those assets. About 90% are owned by mom and pop. And the balance is those investors in between. And you can see the orange bars on the right, top 20 markets and the investor share of market, and who's buying those properties. And you can see that, again, that orange bar is really the driver in every one of those markets across the country. Also important to note that investors don't just play at the low end of the market, they play at all three levels of the market. So in terms of investor purchase activity of all residential properties, they're right around 28% of low price properties. They're about 24% of mid-price properties and probably about 23% of high-price properties. But again, these are investors who are out there who are getting these business purpose loans, and they are buying a significant share of all different types of properties. We have seen a drop off in home flipping. This is the last quarter report of last year from Adam Data. We saw a two consecutive quarter growth spurt of flips, but then it dipped pretty significantly in the last quarter, along with profit trends. And I know that as a lender doing these business purpose loans, you're probably being very, very cautious, and you're making those flippers sharpen their pencils because we've seen all their costs go up too, whether it's taxes, whether it's insurance, whether it's labor costs. We've seen the cost of goods and services go up about 70% in the last decade in terms of material costs and supplies, according to some data from Verisk. And so all of their costs are up at a time when it's hard for them to get premium prices on the properties they sell. So I think that 25 is going to be another rough year for flippers. I don't expect to see us hit the kind of peaks we saw a few years ago, but I am hopeful that we've maybe seen the bottom of the flipping market. We'll start to see a little bit more activity because, again, there are interested buyers out there. It's just a matter of finding a property you can buy, fix, and then flip at a margin that makes sense. Single family rental investors have had a little bit better time, but on average, their asking rents only went up about 2% year over year. By the way, that's better than the apartment market. In the apartment market, because of that flood of supply that's hit over the last couple of years, those asking rents are flat year over year, and in a lot of markets, they're actually slightly lower year over year. And again, if you're dealing with a higher price single family rental, if you're dealing with a detached single family rental, if you're dealing with those rentals in certain markets, your asking prices for rents can be higher and often are higher. But these are the averages. But bottom line here is, um, even though these rents are only up 2% year over year, as a rental property owner, you have the dual benefit of both, rents going up a little bit, but also home prices appreciating. So it's still a really good long-term investment in most markets, as long as you do your math and your homework up front. But again, important for you to know if you're making loans to these people, because their ability to pay you back on your loan has a lot to do with what they're able to capture in rent and their profitability. Just a couple slides on the distressed market, because I know a lot of investors, even a lot of home buyers today, as much as 20% of the people buying properties at a foreclosure auction today say they're owner occupants, just looking for bargains. So foreclosure activity overall declined last year. That is not something I had on my bingo card at the beginning of 2024, is foreclosure activity will dip. But according to Adam, it went down by about 10% on a year-over-year basis. We have not come back to pre-pandemic levels. We are still running at about 65% of 2019 levels of foreclosure activity. And I will point out that in 2019, foreclosure activity was lower than normal levels, historically speaking. So since we've come out of the Great Recession, with all of the risk that was removed from lending, um, and with the ability to repay rules being implemented, and with the strength of the economy coming out of the recession, we really have seen foreclosure activity consistently decline. It bottomed out artificially because of the government intervention during COVID, to where in 2020, just about the in 21, really the only things getting foreclosed on were commercial loans, vacant and abandoned properties, and a smattering of private loans. Um, but right now, we seem to have hit a plateau. January numbers were down a little bit again, and February numbers were up a little bit from January, but we're looking at another relatively slow year. To put this in context, according to the MBA, on average, in any given quarter, about 1.4% of loans are in foreclosure. At the end of the fourth quarter of last year, less than a half a percent, 0.45%, about a third of normal levels were actually in foreclosure. And foreclosure starts, which in any given quarter are about 0.39% of loans, are down to 0.15%. So we're just not seeing it. And even if you compare it to where we were in 2019, which again was lower than normal, we're still well off of both of those metrics. So mortgage delinquency rates are very low. We talked about that earlier. Uh, Mortgage servicers are going to extraordinary extremes to help borrowers avoid going into foreclosure. So we're seeing delinquency rates getting close to where they were back in 2019, but a much lower percentage of those loans are rolling into foreclosure. That's represented here in the distressed market waterfall. This is some analysis done by auction.com. They probably account for about half of foreclosure sales across the country. So this data is probably fairly representative. You see that delinquencies are pretty close to where they were prior to the pandemic. Seriously delinquent loans right about where they were prior to the pandemic. But look at what happens with the properties who go from 90 days delinquent into foreclosure. You're running at about a third below where you were prior to the pandemic. And in terms of the number of foreclosures brought to auction, far fewer, far fewer. And because of that, there's less inventory for lenders to repossess. So the REO inventories, the number of bank-owned properties, is about 30% of what it was prior to the pandemic. The chart on the left is kind of an explainer in terms of why that's happening. If you go all the way back to 2000, most distressed property sales were REO sales, bank-owned properties, and that's been largely true for the last 20 years or so. The second biggest group usually is property sold at auction. But over the last few years since the pandemic, between 55 and 65% of sales have happened in the pre-foreclosure period. So it's somebody who's seriously delinquent or in the very early stage of foreclosure, and they're opting to sell their home rather than wait for the foreclosure auction. The reason for that is that there's $35 trillion in homeowner equity, and even borrowers in foreclosure have a ton of equity because of how high property prices have gone up over the last 4 or 5 years. So rather than risk losing all of that equity at a foreclosure auction, the homeowner is opting to move out more quickly, sell the property, even if it's a little bit of a discount, and capture that cash in the form of equity when they make the sale. And that's going to probably continue to keep these later stage foreclosure numbers down, at least for the next couple of years.
Hey, Rick, can I ask you real quick before you move on? We had a question that came in on the foreclosure topic and had to do with the changes happening with the CFPB.
Mhm.
Um, The question was basically if these rules are lifted and they make changes to the CFPB and what the rules are for ability to repay, what do you see, or is there any forecast or any thought of what that might do to the foreclosure market?
Yeah, I had a great conversation with four of the largest mortgage servicers in the country at the recent National Association of Default Professionals Summit. And they said a couple interesting things. One, um, they do expect that the CFPB will become less punitive, less aggressive in its prosecution of alleged misdeeds by servicers, and because of that, there's a likelihood that servicers will be less reluctant to foreclose on somebody who really has exhibited that they're not going to be able to make those payments. So we could see servicers put more of those folks into foreclosure. But here's the but. Um, they don't anticipate any major changes in things like the QM rules or the ability to repay rules. And their approach is going to be business as usual because they realize that 4 years out, you could have a new administration, you will have a new administration, and you could have a new director of the CFPB who reinstates everything and could reinstate things retroactively if they so decide. And so you could be in a world of trouble as a servicer if you kind of vary away from those rules and there's big changes in 4 years. The other factor that's coming into play is they're seeing a lot of activity already by state regulators. And the states are assuming that the CFPB is going to back off a little bit, and so they're jumping back into the mix. And the reason one of the reasons the servicers are trying to keep things status quo is because they don't want a world where regulators in California and Florida are calling the shots. They'd much rather it be, kind of a national one size fits all approach. And so, no, I do think you'll see more foreclosure activity, partly because the CFPB is going to be a little bit more accommodating, partly because the agencies themselves are clamping down. So the FHA, where most of the distressed properties are today, is now going to limit the number of times a borrower can get a loss modification, a loss MIT package, a loan modification, to once every 18 months. In the last couple of years, you've seen borrowers get 3, 4, 5 loss MIT packages in a 12 to 18 month period. So for those borrowers, that kind of wash, rinse, spin, repeat cycle is going to end. And there are about 40,000 borrowers in the VA program who were trying to get into its VASP program, where the VA buys the loan back and gives them a much lower than market mortgage rate in order to help them make payments. The government right now is arguing about how much they're going to fund that program. So there's 40,000 borrowers who'd like to qualify. The government's talking about capping it for the year at 250. So we could see a number of borrowers enter foreclosure from the FHA and VA portfolios just because the agencies, for one reason or another, are having to tighten up their protocols. Great question. Just to recap, and then we can take some more questions if you want, if we have time. The economy does appear poised for further growth. Nobody's really sure how well or how poorly proposed policies from the new administration are going to impact the economy. We're all hoping for the upside. But we could see some inflation. That could make interest rates go up further. That could have an impact on our market. We could see higher prices on materials and products or labor shortages, but that could all be offset by regulatory relief and lower taxes. So we really don't know. Time will tell. There's more inventory of homes for sale. That could help end the housing shortage, and that will also keep prices from appreciating too rapidly. And we are already starting to see some markets with negative year-over-year prices. Really important to be paying attention in your local markets. If you're looking for a rough outlook for 2025, I am estimating a rebound in existing home sales. Optimistically, somewhere in the 4.3 to 4.4 million area. New home sales at 700 to 715,000. A mortgage rate at the end of the year in the mid sixes, maybe 6.4, 6.5%, and home price appreciation going up between 2 and 2.5%. If we get together again next year at this time, we'll see how we did on these guesses. But in the meantime, I wanted to thank A&D for having me back. Mike, nice doing this with you. And if there's time, I'd be happy to take a few questions before we wrap
Oh,
up.
for sure. We do have one other question out. It didn't really cover through some of your material, but maybe through going through this, you can answer this. Have we seen, you talked about the increased debt particularly in the credit card market, some other auto loans and stuff. Have we seen an increased amount of refinance loans for debt consolidation? Is that something that you've been able to track?
You know, you would expect that. We have $35 trillion in homeowner equity and a record amount of consumer debt. And no, we have not. In fact,
Hmm,
HELOC, home equity lines of credit, HELOC activity has been down for 3 consecutive quarters. So I know the lenders are a little bit tighter with HELOCs and with home equity loans in general, which is usually what you wind up with in a debt consolidation scenario. Refi activities continue to be very, very low. Obviously, there's no rate-based activity going on. Um, so we know lenders are a little bit stricter with their guidelines. We also think, and this is just speculation, that homeowners saw what happened during the Great Recession. They saw people tapping into home equity and using their home as an ATM, and they saw what happened at the end of that sequence, and maybe you're being a little bit more careful about that as well. The other thing that's kind of interesting, Mike, is that the delinquencies we talked about tend to fall off from 30-day to more serious. So in a lot of cases, it's people missing 1 month payment, but then catching back up. And it'll be interesting if we start to see that more serious delinquency rate go up, if we don't see more of these homeowners tap into equity to try and offset that.
interesting. Very interesting. Well, we're running slow on time, so we'll just finish up here if you can. When we send out, we're going to send out the recording and the presentation and everything. So if you have additional questions, just submit them there. We'll make sure we get you the answers. Rick, we did have one ask if you can, if you have those California slides, if you can send those. We have some people, I would assume, in California are interested in investing in California that would like that information. So if you can provide that feedback, we'd like to get that out too, if you don't
Sure.
mind. And just a couple quick closing thoughts here. So I wanted to kind of announce this. We're really excited about the growth in our loyalty program, Advantage Loyalty Program. We just recently announced a new way that you can earn loyalty points through the program. And it's as simple as creating your own disclosure package when you submit your file. So we all like to keep things moving, order those appraisals as quickly as possible in the process. You can complete your self-disclosure package in minutes on AIM on our partner portal. And for doing that, when you close the loan, you're going to earn an additional 300 points just for completing those disclosures. One quick closing commercial. We do want to continue to be your partner for growth. We do offer a very streamlined loan process to get your files in and out as quickly as possible. We have a very experienced staff across the board with a can-do attitude to get your loans taken care of. Solutions that grow, always offering new technology, new platforms, and new programs for you to conduct business, and some of the most flexible underwriting and that can-do attitude and underwriting continues through to make sure that we can deliver on your expectations. Rick, really appreciate the time. I think I could probably listen to you go through this stuff for hours and hours. I'm sure you're probably used to doing that, but we only got an hour today, but we'll do it again soon. Really appreciate it again. And thank you all for joining. I hope you have a great day and a great end of 2025. Everything's going to come in, as Rick said, and we're going to be resetting and getting back to business.
Take care.
Rick, appreciate it. Thank you all. Have a great day.